Imagine owning a private road, where every car that passes by has to pay you. It sounds like one of the safest, most lucrative investments you could make. A monopoly backed by the government, a guaranteed stream of cash for decades. But what happens if the cars just don't show up? Or what if the government that granted you the deal suddenly becomes your biggest competitor? Somewhere in the world right now, an investor who paid billions for a toll road is quietly hoping traffic shows up exactly as forecast. The truth is, the economics of owning a toll road are far more brutal and complex than they appear, and the industry is littered with high-profile failures that have cost investors billions. This is the sober, analytical breakdown of how these deals actually work, from the massive upfront costs to the hidden contract clauses that decide who gets rich and who gets wiped out. Let's start with the basic appeal. A toll road is a physical asset, an essential piece of infrastructure with a captive audience. For decades, governments have turned to private companies to build and operate these roads through a model called a public-private partnership. The most common structure is a concession agreement. A government leases the rights to a road to a private company for a very long time, often 30, 50, or even 75 years, with some deals stretching out to 99. The private company pays the government a massive upfront fee, sometimes billions of dollars. In return, the company operates the road, maintains it, and most importantly, collects all the tolls for the entire lease. At the end of the term, the road is handed back to the government. For a government, the deal is tempting. It gets a huge cash infusion today, while offloading the long-term costs of maintenance. For private investors, the promise is a steady, predictable, inflation-proof cash flow for generations. After all, no one's going to build a competing highway right next to yours, right? This is where the simple business model starts to get complicated. The price of entry here is astronomical, revealing the scale of this financial game. Take the Indiana Toll Road. In 2006, a consortium of foreign investors paid the state of Indiana $3.85 billion for a 75-year lease to operate a highway stretching over 150 miles. That same year, the city of Chicago leased its own Skyway, a nearly 8-mile road for $1.83 billion on a 99-year contract. These aren't just simple asset sales, they're complex financial maneuvers. The winning bidders raise the capital through a combination of equity and a mountain of debt. This leverage magnifies their potential returns, but it also magnifies their risk. A modest shortfall in traffic can be absorbed easily by an all-equity owner, but for a heavily leveraged operator, that same shortfall can trigger a covenant breach on the debt itself. The entire financial model depends not just on collecting tolls, but on collecting enough to cover expenses, maintenance, and the interest on their loans. And maintenance obligations are often written into these contracts in painstaking detail. Operators are typically required to resurface the road on a fixed schedule, replace safety barriers, upgrade lighting, and maintain bridges to specific engineering standards, whether or not the toll revenue that year comfortably covers it. Skimping on maintenance to protect short-term profit isn't just poor practice. It can trigger contract penalties, or even hand the government grounds to claw the concession back early. Regulators eventually pushed back on some of the more aggressive versions of these clauses in later deals, but the underlying incentive structure remains largely intact. So how do you protect a multi-billion-dollar bet? To attract that kind of capital, governments often alter the risk equation in the operator's favor. First, there's the non-compete clause. In its strongest form, this can prevent the government from building a nearby free road that could siphon off traffic. Many modern contracts have evolved instead to include compensation provisions. If the government does build a competing road, it may have to pay the private operator for the lost revenue. Second is the toll escalator. Investors need protection from inflation, and they get it through automatic contractual toll increases. The Chicago Skyway lease, for example, allowed tolls to rise each year, by whichever was higher, a fixed percentage, the rate of inflation, or nominal economic growth. This mechanism is a powerful engine for compounding revenue over time. Finally, there's the government safety net. In some deals, governments have offered minimum revenue guarantees. If traffic and revenue fall below an agreed threshold, the government has to pay the private operator the difference. There's also the opposite provision in some contracts, revenue sharing. If the road performs better than expected and revenue exceeds a certain threshold, the operator has to share a portion of that windfall back with the government. This is rarer and negotiated hard because operators obviously prefer to keep the upside for themselves. Non-compete clauses, toll escalators, and revenue guarantees. These mechanisms transform the business from running a road into managing a complex financial contract. When the forecasts and financial engineering go wrong, the results can be spectacular. The history of private toll roads is filled with bankruptcies. The poster child for this is a Texas toll road a stretch with a record high speed limit meant to relieve a perpetually clogged nearby interstate. The problem was the traffic forecasts were wildly optimistic. Traffic engineers had projected steady, ever-growing demand from day one. After opening, the cars simply didn't show up in the numbers needed. Drivers largely stuck to the free, slightly slower alternative instead, even when the toll road promised to save them real time. By 2016, the company, buried under its debt, filed for bankruptcy, and the original equity investment was wiped out. It was a brutal lesson. If you build it, they won't necessarily come. But what happens when the model works perhaps a little too well? Remember the Chicago Skyway? The tolls for a standard car have climbed dramatically since that original deal. The lease has since been sold multiple times at ever higher valuations. The city of Chicago won't see a dollar of that upside. It's a similar story in Indiana. The state used its upfront payment to fund a decade of transportation projects. But barring a default, Indiana won't see another dollar of toll revenue from that road until the 2080s. These cases highlight the central tension of privatization. Governments get a huge immediate cash payment, but they give up direct control and all future revenue growth for what could be a century, leaving future generations to pay ever-increasing tolls to private, often foreign investors. So could you actually make money owning a toll road? Let's run a simplified calculation. Imagine your fund wins a bid for a 50-year concession on a 10-mile highway with a $500 million upfront payment. You finance this with $150 million of your own equity and $350 million in debt at a 6% interest rate. Your annual debt service comes to $21 million. Add another $9 million for operating and maintenance costs. Your total fixed costs are $30 million a year before you collect a single toll. Now for revenue. The road carries 40,000 vehicles a day at a starting toll of $2. That works out to about $29.2 million in annual revenue. In year one, you've actually lost $800,000. Not a great start. But your contract lets you raise tolls by a guaranteed 3.5% each year. Let's fast forward 10 years. Thanks to compounding, your toll is now about $2.82. Traffic has grown modestly to 45,000 cars a day. That works out to $46.3 million in annual revenue. With costs still at $30 million, your annual profit is now $16.3 million. Now let's jump to year 30. Your toll has escalated to $5.62. Traffic has matured to 55,000 vehicles per day. That's $112.8 million in annual revenue. Against $30 million in costs, your annual profit is a staggering $82.8 million. Over the 50-year life of the deal, total profit could be well over $1 billion on a $150 million initial investment. It's worth pausing on how uneven that profit is across time. In the early years, the business barely breaks even, sometimes losing money outright. Almost all of the real profit is concentrated in the final third of the concession, once decades of toll escalation have compounded on top of a now fully depreciated asset. That's a very different risk profile than most people imagine when they hear guaranteed toll road profits. This is a simplified model. It doesn't account for major repairs or refinancing risk, but it shows the economic engine clearly. High upfront leverage combined with the long-term compounding power of guaranteed toll hikes. Owning a toll road is not a simple business of collecting coins. It's a high-stakes financial game played over generations, built on a controversial partnership between private capital and public authority. For every deal that enriches investors, there's a cautionary tale of bankruptcy fueled by bad forecasts and crushing debt. For every city that gets a short-term budget fix, there are generations of citizens paying steadily rising fees to distant shareholders. Ultimately, a toll road concession is a bet on the future, on growth, on traffic, and on the enduring power of a long-term contract. It's a world where the line between public infrastructure and private profit gets permanently and controversially blurred, one toll booth at a time. If you're interested in the hidden economics behind other industries, subscribe for more breakdowns just like this one.